finance, a la shmup. What are the different types of mutual funds? All right, well, first of all, if you haven't watched our video on mutual funds already, well, go ahead and do that first. It was directed by Steven Spielberg, and we need to amortize the $1 million we spent on it to hire him. Is he really doing Sharknado 7 now? Anyway, mutual funds. There are actually more of them than there are individual stocks. And like hairstyles, mutual funds are available in a wide variety of options. Why? Because investors want to buy slices and dices and combinations of stocks and bonds to fit a ludicrously large and complex set of needs. And with the handy-dandy help of computers, slicing and dicing is really easy today. There are really two categories of mutual funds: bond funds and equity funds. And lots of them are combined as well, like half bonds, half stocks, the centaurs of the finance world. Well, those funds live at either end of the short-term risk spectrum, like here and here. The short-term riskiest funds are high-growth small-cap companies, often technology-related little engines who pay no dividend and trade at high price-to-earnings ratios. The least risky are short-term bond funds, which live way over here like a dead body in a lake tied to a cinder block. They don't go up much. Most mutual funds live somewhere here in the middle of the pure stock-only or pure bond-only ends. So what's a standard mix of stocks and bonds in a mixed or balanced fund? Well, maybe 50-50, 75-25, 90-10, something like that. There is no standard. So let's start with some extremes. Bond funds are shockingly just a collection of bonds. Boring. They pay a bunch of interest. They come due in a wide range of eras or durations, like 6 months in the future to 30 years in the future to even 100 years in the future. Yep, Disney has a bunch of century bonds they famously launched along with Mickey announcing that he was getting a belly button ring. Note that bonds carry many different dials that get turned, from interest rates to call provisions, like how soon the bond, which is in theory a 30-year bond, could be called back by the issuer if rates get cheaper in its future, stuff like that. Well, as far as dials go, a duration is another one of them, like how long until the bond comes due. Well, short-term bond funds tend to be extremely safe and short in term, and generally carry bonds which come due within a year or less. And some bond funds with super short durations, like less than 90 days, are for the most part considered extremely safe. And the industry buzzword here is money market fund. And yes, it's like there is a market for money. Some bond funds are able to take on a lot of risk, or at least relatively more risk than other bond funds. But generally speaking, the riskiest of bond mutual funds is meaningfully less risky than a very conservative, safe-ish, all-equity mutual fund. And one key thing to think about when you think of risk here, there's risk of losing your money, of course. Debts that are due tomorrow are relatively safe when compared with debts due 30 years from now. A lot can happen in 10,000 plus days. If you invest in a risky equity, like a stock, it's not like 1 in a million odds it goes bankrupt. Risky equities go bankrupt all the time. But bonds? Yeah, it really is more like 1 in a million kind of odds that they go fully bankrupt. If you invest in the safest of bond funds, like government bond funds, which only keep treasury bills and notes and other forms of what they call government paper, things backed by the full faith and credit of the U.S. government to tax its hardworking, money-earning, tax-paying citizens, well, you suffer what is called inflation risk.
Illustrative example time.
If you only invest in super safe stuff and compound at 2% a year when you could have taken some risk in a blend of bonds and stocks, well, the risk is that your investment performance underperforms the rate of inflation we all live under. That is, if you're banking on your bank savings account and 2% or something like that working for you when you're old, well, you'll never get to your financial promised land. Inflation will make your retirement savings nut worth less and less. If you only made like 2% a year for all that time, inflation might have been 3% a year, and you actually lost wealth or buying power relative to what everything actually costs. So let's jump to the perspective of taking equity risk in just buying an all-equity, no-bond index or mutual fund that basically tracks the performance of the overall stock market, think the S&P 500. Over long periods of time, like decades, the overall stock market has historically compounded at about 10% a year with dividends reinvested, but it's a hugely volatile beast. Some years the market's up 20%, other years it's down 10%, but over time it goes up lots. If you held only cash in a savings account, you'd be very safe but only get a 2% return over time. You'd have paid a huge price for that safety. How much? Well, in fact, you give up 8% a year in compounding, and after 27 years of saving, well, you end up with 1/6 the amount you'd have saved had you taken that 8% a year extra risk. Remember the rule of 72? You divide the interest rate you're getting into 72, and that's the number of years it takes to double, so 8 into 72 is 9. It means that in 27 years, you double your nut 3 times. Got it? So equity risk is not a bad thing over time. There is a time and a place, and generally speaking, if you have lots and lots of time to compound your investment, well, historically, the stock market's a great place to be. All right, moving fully on to equities now. The short-term riskiest equity funds are generally those which invest in growth. That is, they invest in companies which generally don't pay a dividend, so there's no cushion as to how low the stock can go if they hit a speed bump in their growth trajectory. A given stock trading on hopes and dreams and momentum of the promise of curing cancer can be trading at $200 a share one day, only to discover in the next day's FDA trial results that, it's only succeeding in growing hair on the knuckles of Norwegian women, and, the next print of the stock is closer to $10 a share. So you can lose your shirt quickly on any one stock. So when you think about investing with risk spread among many long-term bets, you think about the diversity and range of investments you make when it comes to risky stocks as being leans into growthy areas in the future of the world. So the would-be cancer-curing, knuckle hair-growing stock is just one stock in a big fat basket of growthy stocks in a mutual fund, so don't let the fall of just one stock in a basket of hundreds terrify you too much. And note that we've made a big deal of short-term risk here instead of just risk. Why? Because over time, investing in growth stocks has been a really good thing in America. The S&P 500 is growthy. Let us gaze lovingly at what 9 to 10% a year compound growth looks like over 100-ish years. If you extracted the non-dividend paying portion of it, the growthier portion of the S&P 500 has grown at somewhere between 12 and 15% a year for a very long time. Compare that with a median bond fund growth scenario of 4 to 6%. Huge gaps over time in varied investment returns, yes. Most investors don't marry entirely one flavor of investment. They like to spread the wealth between bonds and stock, almost literally. So how do you decide between bonds and stocks? Well, generally speaking, old people tend to lean more toward bonds because they can't take much more risk. And young people toward equities. Yeah, duh. Why? Well, time. If you're on the way out the door, so to speak, you don't want to do anything too risky. You just want to play it safe and keep a roof over your head in your twilight years. If you're young, you've got the luxury of taking big risks, failing, starting over again if need be, so you can more safely invest in equities because over time, growth will bail you out of mistakes you make when you're young. And in the scheme of things, investing in equities is not even in the top 100 riskiest things you'll do when you're young.